In this video, I'm going to introduce you to a concept that could take you from unprofitable to profitable. A lot of you are unprofitable and only need small adjustments in your trading in order to find that profitability. Now, I personally believe that this simple change in your trading can take you from unprofitable to profitable, and I've personally seen a lot of results once I started implementing this. The concept that we're going to be talking about is the SMT divergence. I'll show you exactly how to utilize and identify it. So without further ado, let's jump onto the charts and let me show you exactly how to identify the SMT divergence. So let's quickly go over exactly what the SMT divergence is on a drawn example to make sure everybody understands. So if we take a look at my screen, we have a blue chart on the left side and a red chart on the right side. Now, I want you to look at the one on the left side as the NASDAQ 100 and the red one as the S&P 500. These are two very correlated assets, and as we can see, the NASDAQ took out this high. Meanwhile, the S&P 500 failed to take out that high. That is exactly what we call an SMT divergence. Now, why is it important? Well, it's important because if we take a look at the majority of market reversals, there is an SMT present. So it's a very, very strong sign of a reversal. Now, we have a lot of SMTs happen throughout a day. So how do we know which ones we need to look for? Well, we have something called internal range liquidity and we have something called external range liquidity. Now, internal range liquidity would be any highs that are made before the highest point of the range. These highs or lows we will get a lot of SMTs at. Now, the SMTs that happen on the internal range liquidity is not as significant as the one on external. So external range liquidity is again the highest point of the trading range and the lowest point of the trading range. Anything in between is internal range liquidity. So the external range liquidity SMTs are way more significant than the internal one. Now, as I said, this also works with forex pairs. So what forex pairs are we talking about? Well, we have Euro USD with GBP USD. Now, the reason why these are correlated is because they are both quote currency USD pairs, meaning that the pair is made up of two assets, which on Euro USD is the euro and the dollar, and on GBP USD that is the British pound and the dollar. Now, the last asset in these two pairs are both the US dollar, which is what we call the quote currency. Now, when two pairs share the same quote currency, they are moving correlated, which is why we can use GBP USD and Euro USD as SMTs. Now, they are not as correlated as the NASDAQ and the S&P 500. These two are probably the most correlated assets there is, but that does not mean that you can't use GBP USD and Euro USD as SMTs. Now, I did say that the two assets need to be correlated. However, you can also use the DXY with Euro USD and GBP USD. So if we take a look at my screen, this is exactly how you would use the DXY with Euro USD. Again, these are not correlated. They move in opposition to each other. So on Euro USD, the asset, which is Euro USD, took out the high. And on the DXY, which is the dollar index, it failed to sweep the low. That is also an SMT divergence, even though it's not two highs. But because Euro USD moves based off of the dollar index, we can use that as an SMT. We just have to use it in the opposite way. So normally we would look for two highs where one asset sweeps the high, the other one doesn't. With the DXY, we look for a low to be swept on the DXY and a high to be swept on the Euro USD, or a low to be swept on Euro USD and a high to be swept on the DXY. So just as I showed you in this example, the DXY failed to sweep the low, Euro USD successfully took out the high, and that is also an SMT divergence. So those are generally the forex pairs that I would use when looking for SMTs. Now, can you use others? Yes, you can. I just personally don't find them correlated enough for me to want to use that in my analysis. So Euro USD, GBP USD, and the DXY are the three assets that I would use in terms of forex. Now let's take a look at a few chart examples and how you can incorporate your own trading strategy into the SMT concept, because that's the beauty of the SMT. You don't actually need to change anything about your trading. You just have to add one more confluence to it. So taking a look at my screen right now, on the left side we have the E-mini NASDAQ 100. On the right side we have the E-mini S&P 500. And as I said, these two pairs are probably the most correlated assets out of any assets, and therefore these are the two assets that I like to use when I'm looking for an SMT divergence, and generally these are the two pairs or assets that I trade the most. So here's a great example of an SMT divergence taking place. So as you can see, when I hover this high on the NASDAQ right here, it automatically hovers it on the S&P 500. So as you can see, this makes it very easy for us to tell which high got swept and which one didn't. So on the NASDAQ, we took out this high, as you can see right here, but on the S&P 500, we indeed did not take out that high. And that right there is exactly what an SMT divergence is. Now look what the market did after that SMT. It completely sold off, right? So you know that this is a time for you to look for shorts because there is an SMT divergence present. Now obviously we want some type of higher time frame analysis to back up our bearish bias in this scenario, because obviously not every SMT is going to hold, but if you get the direction of the market right, these SMTs tend to hold. So what I'm personally looking for when I am looking for an SMT is some sort of sell-off to happen if it's a bearish SMT, which we got right here. Now, I am a person who enjoys using the optimal trade entry, so I would likely be looking for an optimal trade entry after this SMT had taken place. So let's take a look at that. Optimal trade entry is a Fibonacci extension tool where you draw it from the most recent swing high to the most recent swing low. And obviously this is the high that created the SMT, so that is exactly what we need. Then what you do is you short the 0.618 level, and as you can see, that would have worked out beautifully down to the equal lows resting down here. As you can see, if I draw this out, there are perfect equal lows here. Now, did we create bullish SMTs right here? As you can see, if we take a look at this low here, in the current moment, NASDAQ did not sweep this low, but the S&P 500 certainly did. If I hover the low on the S&P, look at the NASDAQ chart, NASDAQ didn't sweep it, the S&P 500 did. So now we have a bearish and a bullish SMT, but because the bearish SMT held so well, I am not going to anticipate the bullish SMT to hold. Now, how do we know what SMTs are going to hold? Well, technically, we don't know, right? But if the first SMT that we get is bearish and we see a large reaction off of that SMT, there's a high chance that the market is bearish. And if I back that up with higher time frame analysis as well, I can easily hover in between what SMTs are going to hold and which ones are not. Now, again, this is trading, so it's not going to work every single time, but I would not be scared to short this market, even though we had a bullish SMT, because I understand that, okay, we had a bearish SMT and we had a massive sell-off. On the higher time frame, I'm also bearish. So the market really has no reason to respect these bullish SMTs. And therefore, I would be comfortable shorting this bearish SMT with the optimal trade entry. And this is a perfect example of how I would incorporate my own strategy using the SMT divergence. Now, again, this could be any strategy. We have a unicorn model appear right here, and as you can see, it respected that to the absolute T. If you were trading a regular fair value gap, there was a really clean entry right there, and that would have gotten tapped very fast. And obviously we continued to hold that same fair value gap. So there's a bunch of different strategies. I mean, basically any strategy could benefit from implementing the SMT, which is why I think it's such a beautiful strategy. A lot of content creators will show you a strategy and try to make you change whatever it is that you're currently doing. And that is why I enjoy the SMT divergence so much, because you technically don't have to change anything that you're currently doing. Because again, what I preach on this channel is that you stick to a singular system. Does that mean that you can't add or take stuff away from that system? Absolutely not. That's what we call refinement. But you should still stick to that same system over and over and over again. So that was the first example. Now let's look at a few between EURUSD and the DXY, because I don't see a lot of people using the DXY for SMTs, but that is my favorite asset to pair with EURUSD for SMTs. So right here, we have a great example of EURUSD on the left side and the DXY on the right side. Now, if I hover over this low on EURUSD, notice where that hovers on the DXY. On EURUSD, we did in fact sweep liquidity right here. But if we take a look at the DXY, it did not take out that high, right? So that is again an SMT divergence, even though these pairs are moving in opposition to each other. And this right here would have been a perfect place to short. Again, utilizing my personal favorite strategy, the optimal trade entry. After the SMT, we saw a large rally, which again indicates that the SMT is holding and the market is indeed bullish on the EURUSD and is bearish on the DXY. Now, after that rally, we created equal highs, and I can therefore safely anticipate that the 0.618 level is going to hold, again, because the SMT was holding. And why do I know that's holding? Because I got a large rally right after it happened. Now, the reason why SMTs are great is, again, because you can place your stop loss at that low and be comfortable with it. Because if we start violating SMTs, chances are the market was indeed not bullish on EURUSD, but it was bearish. And those are the places where I want to place my stop loss, and that is why I enjoy these SMT divergences so much. Now, I hope you enjoyed this video. This was just a video of me quickly explaining the SMT divergence. I have done videos on it in the past, but I haven't really covered the forex part. I've gotten a bunch of questions as to whether I could do another video on the SMT divergence, so that is exactly what I did here, and I really hope you enjoyed. Try to implement this with whatever system it is that you currently use. See if it helps you on a regular basis, increases your win rate, whatever it might be. It certainly helped me, and I think it's going to help you too. So thank you a lot for watching, and I'll see you in my next video.